Hello everyone, welcome to our Egyptian online seminar group. First, keep your phones off, then if you have any questions, you can ask after his presentation. I have great pleasure of welcoming dear Professor Bob Kaplan. Bob Kaplan is one of the top business thought leaders in the world. He is a senior and Marvin Power Professor of Leadership Development Emeritus at the Harvard Business School. He is a co-developer of both activity-based and the balance scorecard, widely recognized as a seminal contribution to management theory and practice. His current research applies innovations to important problems at the intersections of business and society. He has collaborated with Michael Porter school value-based healthcare initiative, enabling a time-driven activity-based costing to become a global standard for healthcare costs. Kaplan partner with Oxford professor Catherine Ramani to create the e-liability method, the first system to accurately measure corporate greenhouse gas emission across corporate supply and distribution channel. He is the first rigorous approach reporting. Kaplan received a bachelor degree and master degree in electrical engineering from MIT, a PhD in operation research University, and honor doctors from several international universities, elected to the Accounting Hall of Fame. He received many awards, the notable contribution to the Accounting Literatures Award, the Wildman Medal Award, the Mackenzie Award, the Lifetime Contributions Award of the Management Accounting Session, and Outstanding Contribution Award of the Chartered Institute of Management Accounting, UK. Now we will start with dear Professor Robert Kaplan.
Thank you very much, Mohamed, mainly for organizing this seminar during COVID, which has brought us together as an international community, and it shows that even without COVID, we welcome the opportunity to get together in this format. And I was last speaking here, I think 2.5 years ago, when shortly after Karthik and I had developed the e-liability method for measuring supply chain emissions. And so my plan here is I'll do a brief overview of that method because maybe people didn't remember from 2.5 years ago. And also there could be some new people on the call today. But then I'm going to go forward and share with you what we've been doing since the publication of that article in November 2021, go through a couple of the pilot projects that we've done, talk about a second paper that we did on e-assets, which are carbon removals that you can use to offset your own emissions. And I'm going to conclude with our most recent paper that we just wrote, started 2 months ago, and it deals with one of the gaps that we had left, namely, what do you do about downstream emissions? So that's the agenda for today. I hope to do this in, say, 45 minutes, leaving us ample time for discussion. So I'd encourage you as I go through this, if you have comments or questions, just to write it down, and then we can deal with it at the end. Okay. So the first motivation is, why is it not enough to look at a company's own greenhouse gas emissions, what the protocol calls Scope 1? Because, that's would typically be the accountability for any company is what are the emissions you're adding to the atmosphere. And this slide is the motivation behind it, is that for 95% of the companies in the world, they have very low own organization emissions. And so the Scope 1 is really very small. And if you really want companies to engage in decarbonizing, the action comes not so much from what they're doing internally, but what is the implications of their product design and their purchasing and sourcing decisions. Because as this slide shows that the average company, there's more than 5 times as many emissions incurred in its supply chain than in its own operations. And rather than hold the several hundred companies in the world who do most of the scope 1 emissions and say they're the bad people and let's just shut them down, we say, well, the reason that they're in the businesses they're in, producing cement or aluminum or copper, or growing crops on farms, is because organizations and people downstream want to use their products. And those products are essential for our economy today. And so the influence on the scope 1 emissions going up in the atmosphere is downstream, the companies downstream, and the decisions they're making in what components they're designing into their products and who they're sourcing them from and how they're being transported from suppliers up to the downstream company. And so what these are called the cradle to gate emissions, from the origin where the emissions first start, that's the cradle. And the gate is a company's shipping dock when it has completed the production of its products and is shipping it to its immediate customer downstream. So let's look at what's involved in this. Now, the issue when Karthik and I came to this subject 3 years ago, we looked at what the current approach was called as codified in the Greenhouse Gas Protocol and what they called Scope 3, which are both your upstream and downstream emissions. And somehow we had this moment where each of us independently, even though we're separated by the Atlantic Ocean, with Karthik being at Oxford and I'm here in Boston, and said, this can't possibly work. The idea that some company, let's take a company like this car door manufacturer, pretty far downstream, about to supply its door to the ultimate company in the chain, a automobile assembly company, that the Greenhouse Gas Protocol asks them to look all the way back to its supply chain, literally to the companies that are mining iron ore or metallurgical coal, or the sand that goes into the glass in the window, or going into the chips in the electronic door. And the idea is somehow you have to find out how many emissions were done in the components that you eventually are purchasing and producing and assembling into your product. And even a great logistics company like Toyota, world-known, world-class in supply chain management, doesn't even know the names of 85% of its suppliers because they're so far upstream from them. So if you don't even know the names of your suppliers, how can you possibly understand what the emissions are? And how does this company supposed to tell you how many emissions are in the steel or the glass that you put into this car door? And so it was just looked like an impossible task. And the only way that you could plausibly get any kind of estimate here was in the Scope 3 protocol, well, we're not really serious about this. You don't really have to know the actual numbers. Just use average emission factors for the whole industry. And which Karthik and I, being accounting professors, says, well, that doesn't make any sense either. Imagine running our capital market system with a financial accounting model that says, if it's really tough for you to measure the actual cost of goods sold, don't worry about it. Just use the industry average cost of goods sold and report average gross margins for your industry for that component you're buying. And we just couldn't run a capital market system using these averages. But more importantly, there's no incentive to get better. If everyone's using average data, why does any one company want to innovate and do better than this? So that was the problem we saw, and that's what we were writing about. But we also saw the solution was actually really simple. It's a little bit what Copernicus found almost a millennia ago, when they found that, putting the Earth at the center of the solar system didn't quite give you a good model for planetary motion. And for 1,000 years, astronomers struggle with it. And Copernicus says, well, look, rather than position yourself at the Earth and think everything goes around you, move your point of origin to the sun. And all of a sudden, everything made sense. Oh yeah, now it works. Now, Kepler can devise the laws of planetary motion, and so what we have to do is shift our focus not to the downstream company, but start with the upstream, the most upstream company, the ones taking minerals out of the earth and growing crops on farm, or taking hydrocarbons, out of oil and gas fields. And so what we do is just reverse the direction and go downstream rather than attempt to have BMW or Toyota go upstream. It's as simple as that, of shifting the point of origin. And once we do that, we know how to do cost accounting and financial accounting. And so this would be a typical activity-based costing diagram that we've had for 35 or 40 years. And instead of measuring factory costs and assigning it to output products, we look at the emissions in the factory, that's this production process, but also what are the emissions in the components that we purchased from our immediate supplier. So this is going to be one step in the chain, but each company, if it's getting the emissions, CO2 or CH4, methane, from its immediate tier one suppliers, all of whom, of course, we know, then we accumulate all those purchased emissions, the emissions in our purchased products, the emissions that we produce in our own assets, that are the scope 1 emissions, and through a process just like activity-based costing, assign it to our output products. Okay, and that's the ABC step. And so the companies, what we need is have each company assign its purchased and its produced greenhouse gas emissions to its outputs, using this assignment. Now, this wouldn't be done by cost accountants. It would have to be done by chemical engineers and environmental engineers, but the principles are the same. And if we do that, we can now use a very simple inventory equation. One thing accountants know how to do is inventory accounting. So let's suppose we had a balance of emissions from prior periods that we've yet to assign downstream to our customers. But we add to our balance up, how much we produce this year, plus how much we purchased, from our tier one suppliers. We have that report. And then anytime we sell a product, the customer owns the product. We transfer the title of the product to the customer, and the customer now has the emissions profile in its purchased goods and services, one of which is from us. And so since it's an accounting audience, we can use T accounts. It is an e-liability. We call it, why is it an e-liability? Is because we've actually, on the asset side, we've produced carbon dioxide in the atmosphere. So if we had nature's balance sheet, we've increased the supply of CO2 molecules. This is not a good thing because of climate change and global warming. And so we almost have an obligation to offset that. And so we start with the liability of how many emissions we produced and purchased yet to send downstream. We add the emissions in our purchased products, as I showed in the previous slide, how many emissions that we produced, our own scope 1 emissions, and then those are now transferred to our output products, and they'll get transferred to the customers. And anything left over is the start of next period's e-liability account. So the customer takes its purchased emissions from us and all its other suppliers, its own produced emissions, sends it to its customers, and it sends it downstream. So this is the whole algorithm. And this is inventory accounting. That was the previous slide, the equation. And so with very simple cost accounting and inventory accounting, we've actually solved the problem of tracing emissions down the most complex and diverse supply chains you can have. With each entity, it's informationally very simple because each entity only needs to know its direct scope 1 emissions, the emissions it purchased from its immediate suppliers, and it only has to send this information downstream to its immediate customers, its tier 1 customers. And by having every company in the world, and it's not just companies, as you'll see, it's hospitals, it's universities, it's government agencies, everybody can do this simple algorithm and be able to trace and therefore improve the carbon content in all of the products and services that we purchase and produce. So that's the whole algorithm. Now, we also can get into more accounting, because now what happens if you're not just purchasing components, raw materials, or electricity going into your production process, but suppose, go back to the mining company. In order to mine the ore, it had to buy a big ore mining machine from a company like Caterpillar or Komatsu. And so when it purchased that big machine, there were a lot of emissions. It gets a report how many emissions were produced to make this very large machine and deliver it to your mine. And so that's all pre-production emissions. And this would be like a multi-period asset. You don't want to assign all of those purchased emissions from a capital equipment and to the products that you made in that month or that quarter or even that year. You would amortize them just the way we amortize property, plant, and equipment on our financial asset sheet. So one of the projects we did was for a very large oil and gas company. And so you want to think that as they're operating and they're exploring for emissions, there's a bunch of, exploring for the petroleum and natural gas fields, they're generating a bunch of emissions on that. They find the field, so now we have to purchase pipes to sink down into that well. Those pipes have emissions associated with their production and transportation. And so there's a lot of emissions from that construction. Then we have to do a pipeline on shore. And then we have to build our refinery or our processing plant for the oil or the natural gas. And so you can see there's a lot of emissions that have taken place just to create the asset that's going to do the production. But again, we know how to do this as financial accountants. So we can, this is the red line here. We have to capitalize all the pre-production emissions associated with finding the field and getting all the infrastructure in place to bring it to the refinery, plus the PPE for the refinery. And then so those would be capitalized and amortized, and the operating emissions for the refinery is, moving the petroleum or the natural gas from the field to the refinery, operating the refinery. We'll have a bunch of scope 1 and scope 2 emissions. And then when we've got the finished products, we'll be transporting them to our immediate customers. And so we have a combination of both amortization of capitalized emissions as well as emissions from operations. So that's the method. And we use the inventory equation or use this report. Every company in the world can, and every hospital and every university can have the same supply chain report on cradle to gate emissions. What are your opening liabilities? How much did you purchase from your suppliers? How much did you produce in your own operations? And then how much are you transferring out to your customers? The beauty of this, unlike the Scope 3 protocol, is that first of all, the only emissions that go in the atmosphere are Scope 1 emissions. So there's never been one molecule of a Scope 2 or a Scope 3 emission that has ever gone in the atmosphere. So we need an accounting system that only counts Scope 1 emissions from all sources. But what we want to do is have it calculated and in principle audited once and only once. And the greenhouse gas protocol almost prides itself that they can count emissions multiple times. And they get more and more companies kind of counting the same emissions. The counting system doesn't work that way. They're measured, calculated once and only once, where they occur, anywhere in that supply chain, which will make it more accurate, and also the ability for assurance. It can be assured there. And the important part is not just that we can run a good accounting system here, is that this is actually management information, that every company will see the actual emissions that are incurred in order to produce their products and services. And when they make improvements by redesigning products to use less carbon intensive components or choosing lower carbon suppliers or lower carbon transportation methods to bring the products to their factories, you know, there's a reduction in emissions in the world. This is good. And this is how we're going to decarbonize supply chains. And if you want to decarbonize, you can't use this with average information. You have to get the actual embedded emissions in the products and services you're purchasing from your thousands or tens of thousands of suppliers. And this kind of beautifully simple accounting system enables you to do that. So this was the fundamental advance in this. So just to give some examples, probably shortly after my talk 2.5 years ago at the Cairo seminar, we started working with a tire company in Indonesia, a very large company. And they said, Bob, Karthik, we have more than 200 suppliers. This is, how are we going to go about doing this? And we say, okay, look, Karthik and I are both engineers. We want to get it, approximately right and not let the best be the enemy of the good. And so we talked with them and they said, well, that 4 of their components, as you see here, account for 86% of the weight of a tire. And we thought that would correlate pretty highly with the 4 suppliers that have produced the most Scope 1 emissions in the production and transportation of their products. And so they went to each of the 4 companies and got an estimate of the carbon intensity. And this next slide will be a little hard to read here, but these are the 4 products. This is the percentage of weight in a tire. And each one of the companies gave an estimate using their current production process of how many tons of CO2 emissions were produced per ton of product that they were transmitting to the tire company. And these are indexed. So we index carbon black as 1. You can see synthetic rubber and steel are more carbon intense by weight than carbon black, natural rubber less. But this enabled us to them to calculate the tons of CO2 emissions per ton of output of basic tire material. And then we figure out how much tire material goes in a standard passenger tire. And that's the bottom line here, which also includes the tire company's energy consumption to make the tire at its factory, use of natural gas and electricity. And the neat thing, I don't have the other slide here, is the tire company went back to the 4 suppliers and says, can you reduce your carbon intensity at all? And 3 of the 4 came back and says, oh yeah, sure. No, we have new processes that are much less carbon intensive. Nobody's ever asked us about this before. And they said, well, we're asking because we want to be able to tell our downstream customer, one of which is BMW, that we are producing a lower carbon passenger tire. And the companies came back, and when the new estimates, they said just using some of the new technologies they were putting into practice, you could get a 26% reduction in the carbon intensity per standard passenger tire. And that included the tire company using solar panels and natural gas instead of electricity being produced by a coal-fired electricity plant in Indonesia. So you could see the opportunities for improvement that were going on. In the last year, I was working with a colleague of mine at the Harvard Business School, Shirley Liu, and we wrote a case study about this in another setting. And this is Harvard University building new buildings. And again, Harvard doesn't have very much Scope 1 emissions that we produce with our own assets, buses that go across our different campuses. But we build a lot of buildings. And the buildings going up on our campus have materials such as concrete, copper, glass, aluminum, all of which generate a large quantity of emissions in their basic production and transportation. And the sustainability head at Harvard told me about this small company in a nearby state, Connecticut, where an inventor had come up with a cement substitute, technically called positive, that could replace up to 50% of the cement in a mix with this ground glass that's made from discarded consumer glass that they got out of waste dumps. And so this ground glass, which is a cement substitute, has basically 5% of the carbon intensity of the cement, made normal Portland cement, which is the most polluting material we have on Earth. If cement were a country, it would be the third largest emitter behind China and India in carbon emissions. And so the case actually traces the supply chain from getting the recycled glass, grounding it up, shipping it in a truck up to Boston, where it comes to another customer, a supplier, a concrete maker, Boston Sand and Gravel, and they mix it with a bunch of other materials, eventually delivering the concrete to a site. So all of you that are accounting academics that want to teach this content, this is a new case. It was taught in the first year MBA program at Harvard Business School in November. And unusual, for the first time a case was taught, it was one of the most popular cases in the whole course. It really worked, and Shirley produced this great spreadsheet. It was modeled after the tire company spreadsheet, where the students get to enter some of the numbers that are in the case and fill it in the spreadsheet, but then it automatically calculates what the carbon intensity is per ton or kilogram of concrete that's used at the building site, and whether you use 100% Portland cement or 50-50 mixture with the ground glass substitute. So they get a feeling for the calculation and how it can go through a supply chain. And the supply chain starts from the plant in Connecticut up to the Boston Sand and Gravel concrete mixer, and then to the site. So it's quite a simple, short supply chain, only involving 3 levels, not counting transportation. But we include transportation. So this company said, well, if Harvard was going to source this product from us, we'll consider building a plant in Massachusetts to supply Harvard or MIT and Mass General Hospital and a bunch of other customers there. And that would reduce the transportation cost in emissions. And the question is, how much do you save? So that's all part of the case that you can work. But it's a really very good illustration of how the e-liability system works in a real setting. It's actually happening, but a simple setting. So just to so those are 2 of the sites. I talked about the tire company and Harvard University. We've worked for one of the largest cement companies in the world, Heidelberg Cement. We're doing this in healthcare. How many emissions to do a knee replacement? So we're doing that calculation, and it's, the anesthesia, but also the knee implant. What are the materials you're being used to do it? Suprema is a building materials company based in France. Tata Steel, so we're looking at the difference between steel made from virgin steel, from the whole minerals and blast oxygen furnaces, but also what's the implications of using recycled steel. For agriculture, we're working with Unilever to look at the whole agricultural supply chain, from dairy cows, who have a certain amount of flatulence, but also their waste products generate methane, and that's a big producer of methane, which is about 80 times more heat trapping than carbon dioxide. A really neat project, a good project with Chevron in natural gas. So these are all going on. They're all going fine. The method is easy to explain, easy to apply, and gives managerially relevant information to the companies. But we're also working with what we call the enablers. You're not going to keep doing e-liability counting on Excel spreadsheets. So SAP is producing a new product they call Green Ledger, and that's based on e-liability principles. We're working with the assurance companies. So these do have to get assurance at each stage. We got with IBM. This came up in the Harvard cement example. Because how is Harvard going to explain to its faculty, students, and alumni that it's using lower carbon concrete and have them believe it? So we had to get what kind of assurance could we get, and how do we get the assurance that's pretty far upstream down to a downstream customer? So it turns out, near as I can tell, this is the first socially useful application of blockchain that we've ever found. And IBM already had a blockchain solution that it had done in food retailers, and they came online with us and they said, okay, we just have to relabel the variables to get a blockchain solution to trace carbon emissions down these very complex chains and have them be secure and private, but accessible by any downstream company. So they can look backward to see, where did the emissions come from, and also have the assurance document there at the point of where the emissions are incurred. Just quickly, the Hitachi Energy, which makes transformers for electrical generating stations, was interesting because their biggest material, they had only one material that was the carbon producer, and that was copper. And what they found was, and the conventional wisdom is recycled copper is less carbon intensive than virgin copper coming out of a mine. And what we found was, well, sometimes, not always, that in fact, the copper that they got from a northern Swedish mine, which was powered by hydropower and a very rich ore, so that there was a very high yield as you extracted the ore out of the ground, and it was close to where the factory was, the copper processing factory, that actually had 1/3 the emissions per kilogram of copper than recycled copper, because recycled copper involves incinerating printed circuit boards to get rid of plastic and materials you don't want to get to the copper. And that copper from recycling was 3 times more carbon intensive than the copper coming from this very kind of rich hydro-powered mine in northern Sweden. But the recycled copper had 1/3 the emissions of copper that came from, say, Chile, another part of the world, which had an old mine, very low yields, powered by coal-fired electricity. And so it was like a 9-to-1 ratio between the copper coming from, say, a Chilean mine versus a northern Sweden mine. And here you thought this was a commodity. Copper is copper. In the greenhouse gas protocol, there's one emissions factor for all the copper. Well, that ain't a commodity. It's an order of magnitude difference on what looks like a commodity product. And we consistently find that, whether it's steel or it's cement, or tires, what you thought was a commodity, when you do measurements in units of carbon content, they're not commodities at all. And so there's sources of comparative advantage and differentiation. Okay, so that's where we are, and we're moving forward on this. Okay, so now we get to the offset market. So a lot of companies trying to get to net zero are saying whatever emissions I produce and that I purchase from my suppliers, I'm going to neutralize by buying these offsets. Or if I am a climate activist or a climate executive and I fly to an international conference in my private jet, not to worry because I'm offsetting this by, I'm neutralizing these by buying carbon offsets. And some of us, when you go on a plane that says, want to spend $3 more, you can buy a carbon certificate to offset the emissions that is being produced when you fly on the plane. Well, the short answer is don't buy those certificates. Virtually 95% of these certificates are fictitious. And this, a year ago, there was an article in The Guardian, and this study has stood up, which says there's close to $1 billion of trading, maybe more, on these kind of offset certificates. And if you want to buy them, you can. I mean, there are our children, my grandchildren buy these non-fungible tokens, and they spend real money, not for anything real, it's for a digital image. And most carbon offset certificates have all the integrity and carbon removal properties of a digital certificate. Not one molecule of new carbon has been removed from the atmosphere by purchasing that certificate. And the reason is the difference between 2 kinds of offsets. There are removal offsets. We're actually pulling existing carbon out of the atmosphere and permanently sequestering it so it doesn't get re-released. These are good. I mean, these are real offsets. But the great majority of what is called an offset are avoidance offsets, where you're paying somebody not to do something bad in the future. And so 6 months ago, when Harvard had its climate conference, and I was going to go every day to attend, and I was all inspired, I thought, well, gee, maybe instead of driving my car to Harvard and back to my home, maybe I'll ride a bicycle, and save all that carbon. And I said, okay, I'm going to call up an exchange and said, can you, pay me for riding my bicycle back and forth for a week? And someone will buy that as an offset to their real emissions. Well, that's kind of what it is you're paying for when you get an avoidance. It's about someone who says, I'm going to do something bad unless you pay me not to do it. I'm going to release existing carbon in the atmosphere. So it's good to pay them not to do it, but that doesn't remove any of the carbon from the atmosphere. It just, in a way, stops future things. And as accountants, we do accounting for past events, not for some promise of a hypothetical event in the future. So our first principle for removal offsets is that you can only use real removal offsets, not avoidance offsets, to offset your e-liabilities. And we want to give those people who are creating these removal offsets credit for it. But avoidance offsets cannot offset the Scope 1 emissions that you are producing or that you purchased in your products and services. And we want to have a trading market. Markets are good because many of the places and organizations that have the capability of doing removals don't have access to much capital. And so this is a great source of capital to motivate those who are in a position to create a removal offset, say by planting new forests or planting mangroves, to do that. And so we want this to occur. We want the people who are most efficient at removing carbon from the atmosphere to do that. And they don't have to be self-financing. We can finance that by people who want to get access and credit for the carbon that will be removed. So those are the first two principles. For the next three, we just have to think of this stylized example of a forestry-based offsets. I mean, there are two kinds of removal offsets. One is things that occur in agriculture, as illustrated here, but there's also mineralization, where the carbon dioxide is captured, put underground, and stored, where it hardens into the minerals in the earth. That's actually the best type of carbon removal, but it's the most expensive and least efficient right now. But consider this forest. So you plant seedlings now, and it takes about 10 years to get to scale where it's starting to capture carbon. Then you have about a 20-year period where the tree is growing and each year capturing more and more carbon. And then for another 20 years, it's mature, it's intact, we hope, capturing the carbon. But then at the end of the life, it could burn down, or it could decay and deteriorate. And you have to kind of replenish the carbon that otherwise would go in the atmosphere. So think about this model, and the question is, what is the accounting for the carbon removal for this 50 or 60-year asset that we've shown here? So the first is, when can the person producing the removal recognize this as an asset and potentially be able to trade it to some company that wants to get access to the carbon removal? And then Karthik and I just went back to accounting principles. Asset recognition, when do we have an asset, is when the multi-year benefits are both probable and estimable, okay? And so if we can understand the magnitude and the likelihood of real carbon being captured, then it becomes, we think, qualified as an asset and available for trade. So when would a removal asset not be considered legitimate for a trade? Is that you don't have confidence that whoever said they're going to capture carbon in the future will be able to carry this out. Okay. And there's a moral hazard issue we have to think about. So we can think about the agency. There is a problem because the carbon has to be sequestered for a long period of time. And you don't want the producer of the offset to lose accountability for sustaining the removal. Because otherwise bad things could happen and the carbon could leak back up into the atmosphere. So there has to be some limited accountability. And we thought it's a little bit like how a general partner operates, with an investment firm, that they're selling a limited partnership. We need to have the general partner keep some skin in the game so that they continue to invest wisely and manage and monitor their investments. And so we need some agency left here for the carbon producer. Okay, but here we get to asset. When is a carbon asset actually produced? And given the ability to fund the producer through a market, that they could sell the rights to the future carbon capture. Now, so suppose now I'm a downstream company. I'm the tire company, or I'm an automobile company, or I'm a technology company that's using big data centers. When can I use a purchased offset to offset against my Scope 1 liabilities that I've measured with the e-liability method? And here again, we go to basic accounting and think about revenue recognition. So even though an organization may get a cash in advance of producing and delivering a product, it can't recognize the revenue until it delivers the underlying economics of that. And so we always have the example we use in our revenue recognition class, that Taylor Swift could sell all the tickets to our upcoming concert, or even to our album that she announced yesterday on the Grammys. So they get all the cash, but they can't recognize the revenue until you've actually delivered the concert or shipped the album in this case. And that's the same thing here we want to do with the carbon accounting, that even though you put it as an e-asset on your books, you can't net it against your e-liability until the carbon has been captured. And so we need a report from the carbon offset producer, wherever it might be, as to when it has started capturing carbon and how much carbon has been captured this period. And when I can do that, then I reduce the quantity of emissions that are in my output products and services. And so the downstream company now can perceive me as a lower carbon supplier, because I've offset all the cradle to, not offset, some of the cradle to gate emissions with legitimate carbon removal offsets that have actually pulled lots of kilograms of CO2 out of the atmosphere. So there's kind of a carbon recognition principle that should be here. And you can see that we're going to need a lot of auditing and assurance to make sure this is real and not fictitious. And then the final one is, unlike typical trades of financial securities and commodities, this trade actually has to have a 1,000-year life, because that's the estimate of how long a CO2 molecule that's been emitted in the atmosphere remains in the atmosphere. So this is kind of a challenge. Bad things can happen over the next 1,000 years, maybe over the next 50 years, or maybe even the next 2 years. When we have forest fires in Canada, and a lot of removal offset went up in smoke and are now up in the atmosphere, the carbon's in the atmosphere. So for any removal offset, you need audits to actually validate that there's not been an impairment of the asset. The asset is how much the kilograms of carbon that's been captured and sequestered. And if there's been damage due in the forestry assets due to fire, disease, or deforestation, then you have to reverse this entry on the purchasing company's e-ledger sheet. And so offsets that are already taken and netted against its outputs, actually you're going to have to reverse that and apply the now higher carbon that's just been released to your next year's products and services. So we have to be able to think about this impairment, and again, coming in with the auditing. There's a little bit of good news here. Maybe the forest grew faster and larger than you really anticipate, and is actually capturing and sequestering more carbon than you originally intended. And so we should allow, therefore, for accretion and allow that carbon offset to increase if you get a report actually that forest is more robust. And again, you're not sitting there leaf by leaf looking at the oxygen. You can use this with satellite imaging and scientific models to really estimate how much carbon has been captured in a forest or a mangrove plantation, and what the delta is from year to year. So, we will need this dynamic kind of accounting. Okay, so we've now done both liabilities and assets. But then now we get to the part that has been missing, and that the people advocates for the greenhouse gas protocol have been accusing Karthik and me that we're ignoring downstream emissions. And we've already written why we don't have downstream emissions in our model, because company has no control over the downstream emissions. Okay. Once I sell my product, I have no control what my customer or the customer's customer does with it. And I don't know what it is. So it would be completely subjective and unauditable. We wanted the cradle to gate supply chain and own company emissions to be subject to rigorous accounting standards and models. But we finally got around to thinking about what's bugging these people. Why do they 2.5 years, they're still, blaming us for ignoring downstream emissions? And so as we thought about it, we realized where the gap is. What's the exception to our rule? And the exception is when consumers use a product and combust energy to use it, their Scope 1 emissions are not counted anywhere in a corporate, nonprofit, or governmental e-liability system. And we're not going to get 8 billion consumers in the world to create their own little e-liability statements. So the question is, how can we get some downstream accountability when consumers are combusting energy and setting emissions up to use a product? So the first, so we have about 3 principles on that. I'm just going to go quickly on this. Is that what this means is any B2B company is exempt from downstream emissions, because any emissions caused downstream will be picked up by some downstream corporation when they use our product or service. And we don't want to double count. So we don't have to worry about B2B companies. It's only B2C companies that's selling a product that the consumer can identify. So a package of food that I have to heat up, or detergent, laundry detergent, that when I use it, I have to heat up the water in the washing machine. Or when I drive a car, I'm using the car, I'm burning the gasoline in the car, I'm running on tires in the car. And so all of those companies that supplied that could be implicated in my emissions occurring when I drive the car, or when I play my gaming console and consuming electricity, or heating my home, or air conditioning my home. So these are consumers that are using a product and generating energy when they do that. And so to do this, we had to go back to, again, a fundamental equation here. And again, it's cost accounting. I use this all the time. The cost of any material is the price per unit of that material times the quantity of that material that goes into a product. So we all teach this cost accounting first class. So cost of steel in a car is how many kilograms of steel in the car times the cost per kilogram, price per kilogram that we paid for it. So we just do the same thing for consumer emissions. A consumer's total CO2 equivalent emissions is how many emissions per unit of use, per minute of cooking time, per washing machine load, per hour on the gaming console, per kilometer driven, times the quantity of units that I use. How many minutes did I cook the food? How many washing machine cycles did I have? How many kilometers did I drive? Okay. And what the company can be responsible for, here's the big idea. It can be responsible through the design of its products is the amount of emissions per unit of consumer use. So, what's the fuel economy of an automobile is determined by the automobile manufacturer in its design decisions, including what energy source it uses, electricity or gasoline or diesel. But the units used is really up to the consumer. And, BMW or Microsoft or Unilever can't control how much of the product is being used or how much total, which influences the energy. So our thought here is to be accountable for the rate of emissions produced per unit of use. And this can be disclosed. Okay, it's not an accounting number. It hasn't occurred yet. It's something hypothetical in the future. But companies can influence this, and therefore they could be accountable for it. And so that's our proposal: is that the downstream disclosure, is for the B2C companies whose, when consumers use the product, end up combusting energy. Now, a company that publishes a book, okay, I can read the book, but I'm not generating any emissions when I read a book or wear an article of clothing. So it's, again, only those B2C companies who, in order to use the product, consumers are combusting energy in some way and having pollution. And so they can be accountable for this first term here, the rate of emissions per unit of use, but not the second, the quantity of use. And as we say, this is disclosure information, would be like in the MD&A to your e-ledger report. And just again, because it hasn't occurred, it's subjective, and there's a lot of multiple counting, because when you drive the automobile with an internal combustion engine, the automobile company has some accountability for the gas mileage, the petroleum company has, and the tire company, the rolling friction. In fact, just in today's paper, there was a proposal, a new environmental regulation on the how much rolling friction on a tire is allowed in order for it to be sold. So sometimes our simple examples turn out to end up being real as they come up here. Okay, so this article I've just entered it into the working paper series in SSRN, so you'll be able to access it there, and it has been accepted for Harvard Business Review in July and August of this year. So you get a copy of this when we PDF it, make it available for you. These are all the articles that have the theory we have. I talked about this is the newest paper that we just finished earlier. I guess it was last month. And all of these you can get access if you go to our e-liability website. So this is a nonprofit that Karthik and I formed. We don't get paid for this, but we had to hire people to work on projects. So we were fortunate to get a donation that enables us to hire a few people that help staff and support the various pilot projects. And with that, Mohamed, I am, I think, finished. So let me stop the screen share and turn it over to comments and questions.
Thank you very much, dear Professor Bob Kaplan, for your contribution and your effort. It's really an excellent presentation. Thank you very much. Now, if anyone have any questions, please use the chat, the raise hand function, and we open your mic to ask. Yes, Professor Mark, you can open your mic.
Let me let Mark, who co-author of, and I hope still a friend of mine here on this carbon accounting, take a friendly question.
Hey Bob, this is great work. I've been following some of the issues related to cloud computing and the server farms. And as I understand it, the size of the carbon footprint in this industry is now bigger than that of the airline industry. Mm-hmm. So I'm wondering if you have investigated this particular issue.
Yeah. So it's a very timely and thoughtful, important comment. Technically, I didn't talk about scope 2 at all, which is electricity production or consumption of energy, such as electricity. In a framework, it's actually already covered in scope 3. And because it's a supplier, electricity is an input service, just the way concrete or a tire is. But for the greenhouse gas protocol people 20 years ago gave it its own name. I think they thought it was the only scope 3 quantity that they knew how to measure, kilowatts of electricity. So you can measure the kilowatts of electricity. That's easy. The question is, what's the price per unit? What's the CO2 per unit of electricity supplied? That turns out to be complicated. And I think my sense is the existing standards in the greenhouse gas protocol, where you are in California, are really crazy standards. I mean, it's in the same bad shape as carbon offsets were. People call it the Wild West, of accounting. And I always thought that was unfair to the Wild West, because the Wild West at least had sheriffs and judges and jails. They didn't work perfectly, but but this is worse than the Wild West. So, in fact, so Karthik and I and Mark Rostin at Stanford, who worked on the offset paper with us, we said, we think this will be our next project, is to get to the electricity and get it valid, because it's really, they have strange practices going on there. And it's important, just as you said, there's a huge amount of emissions on these data centers, and running blockchain, and all this cryptocurrency is left completely off the hook. I mean, you can't find any socially useful purpose for cryptocurrency. It's actually destructive. And it also consumes huge amounts of electricity. So, yeah, so that's all, so we can do a first order pass as to what the CO2 per kilowatt of electricity is, but it really depends upon, what's creating the energy. And again, the climate advocates would like to think that solar and wind and hydro has zero carbon associated with it. And that's in order to get hydro, you have to build a dam. And what is a dam made out of? A huge amount of concrete. And so there's a huge amount of emissions to build a dam, plus all the steel turbines that go into it. And then it turns out where the wind blows and the rain falls and the sun shines is not where people are in their Teslas. And so you have to build this enormous infrastructure. It greatly exceeds the capacity of our grid. And so if you build a grid, what is that going to consist of? It's going to consist of copper, concrete and steel. And so it's important that we not just look at the operating emissions from electricity, but the amortization of all the infrastructure that had to be and will have to be created, which will generate a huge amount of emissions before we produce the first new kilowatt of electricity or distribute it to where people will have their electric cars. And the nutty thing about I shouldn't say that. An interesting feature of the greenhouse gas protocol is they have operating emissions in scope 2, but the capitalized emissions that I talked about, to build these facilities and the transmission and distribution is sitting somewhere in scope 3. So they don't even have an integrated view of the carbon content per kilowatt of electricity. So again, a lot of opportunity here for new work here.
Thank you.
Sorry, that was a long answer, but you hit something that, is right at the top of our agenda right now.
Yeah. Another question from Nicholas.
Yes, thank you, Mohamed. So yeah, thank you for the talk. It was very, very interesting. I just have a brief question about the disclosure of the downstream emission paper. So you mentioned that companies should be doing it for B2C transactions, but it's two questions. How would that really be different from current labels of energy efficiency? With fridges, at least in Europe, you have a rating of A, B, C, how energy efficient they are, or TVs or other appliances. And wouldn't it also make more sense to basically then supply the data of the real emissions by the electricity companies, who, of course, as you said, there's still room for improvement, but who have better data than just average data?
Yeah, so I think the first part, Nicholas, is the energy efficiency on the appliances is good, but we have to get beyond the energy efficiency to get to the emissions. And the issue is, somebody in Europe is operating their refrigerator with electricity from coal-fired plants, and somebody else may be operating the refrigerator based on hydropower or solar power. So we're going to have to work through, do we want to understand kind of what the mix of consumers are to come out to what the emissions profile is, because it will depend on the source of the electricity to get to the emissions per kilowatt hour. Because that's, you really want not just the kilowatt hours per unit of use, you want the emissions per kilowatt hour and have that reported in some way. And then I forgot the second part of the question.
So the second part is basically whether it would make more sense, other than, let's say, Samsung is making a refrigerator, to have the electricity provider in the end tell you about the customers, also about the real emissions.
Yeah, well, first of all, the electricity provider, well, anything that goes to a company, the company will pick up in its e-liability. So it's only the electricity, the kilowatt hours consumed by the consumer. And yeah, but see, that would be the kilowatt hours into my house. And you're not going to know how much of that is to heat my house and how much of it is to cook my rice and how much of it is to wash my clothes and dry my clothes. And you know, that's where we would lose accountability down at the company level to be able to do that. But these are all interesting things to kind of work through and decide, you know, what we can measure and who we might hold accountable in some form for that.
Okay, perfect. That makes total sense. Thank you.
Kelly? Yes.
Good morning. Hi, Dr. Kaplan. Thank you for this webinar. So I think, Nicholas, you already tackled my first question, so I won't repeat that one. Thank you for heading that off. But it's really interesting that Mark brought up blockchain, or that brought up kind of the issue of data centers and server farms and their endemic relationship to the blockchain. And I just wanted to kind of confirm whether the e-liability method presumes dependence on blockchain for kind of secure verification. And essentially what the relationship there is with what you've referred to as market enablers, which in many cases are private companies such as IBM or Microsoft or others, and kind of any thought that's been given to like the ideal treatment of blockchain as either a private good or a public good, given how necessary it is for e-liability.
No, we haven't gotten to that stage. And again, what I want to say is that blockchain is a solution. It can do this, but I'm not saying it's the only solution or the best solution. And related to it, and I don't understand all this technology that much, is tokenization, where you can tokenize items and have that information come in. And this is exactly what companies like SAP and IBM are working on. And I've stayed neutral and agnostic about this. But yeah, so I don't want to say blockchain is the only solution. I'm an engineer there. I just say at least it is a solution. Now, which leaves open ways for other people and data technologies to be deployed. But we do need, so here's really a big difference between this carbon accounting and financial accounting. In financial accounting, I don't need to go beyond my tier 1 suppliers. You know, I just need to know, you know, do we have a valid transaction? What was the price of that? And that's the end of it. But in the carbon accounting, I can't rely totally on my immediate supplier because they're relying on information further upstream for their suppliers. And I need to know the validity of that. And so I need to have visibility all the way upstream, maybe back to the mineral company of the farm or the hydrocarbon company, to have both supplied the relevant data and have an assurance document there that I am able to check. And I can look at who the auditor was, you know, in the Congo or in Indonesia on that item and decide how much confidence I have in that assurance. And so we do need an ability to look all the way downstream, I'm sorry, all the way upstream to see that kind of data, but do it in a private and secure way. And so you know, blockchain is like a metaphor for the functionality that we need.
Yep. Makes complete sense. And I appreciated your metaphor on the Copernican revolution of moving away from an egocentric view of scope to a value chain based view. That's very refreshing. Thank you.
Yeah, no, it sounds kind of immodest to compare us to Copernicus. That was a much more important discovery than what we did, and also harder. But it kind of gets the point, that where you stand and which way you look makes a huge difference in this field.
Absolutely. Thank you.
is there another question? Professor Steve? Yeah. Yes, Sandra?
Thank you. Thank you, Bob, for the presentation. I really like your work and I like the e-liability framework. I have a higher level question. How easy is it actually to get scope 1 emissions from the very first upstream step? Let's say the farmer in Argentina. How skilled are they? How capable are they to provide these estimates?
Yeah, well, the answer is it varies. If you're dealing with BHP, great Australian mining company, mining ore, or any of the other large extraction companies, it should be straightforward to be able to do that. And no, whether you can do it for an extraction company in the Congo, less sure about the reliability. But in principle, it can be done. Clearly, for the example you gave, the smallholder farmer in Argentina or Ecuador or Cote d'Ivoire, it's harder. But I think as we talk to the agribusiness companies, they actually have pretty good models, about what generates the emissions. And they can actually, even with satellite photographs, they can look at a farm and knowing the crop and the method that the farmer is using, come up with at least plausible estimates, where you get the first digit right and know where the decimal point is, which would be good enough. Because then there would be an incentive to work with these smallholder farmers to make them not only more efficient and get higher income and yields, but also produce less carbon and other forms of pollution in their growing processes. And so as we talk to the agribusiness companies, including Unilever, I think they feel that they can get a handle on it. But it won't be our first project. Our first projects with them are going to be with large plantations, not with bunches of smallholder farmers. So we kind of get what the models look like and then try to generalize the models out to a smallholder farmer and have some accuracy with that.
Perfect, thank you.
That's why I'm excited to be working with Unilever. There's an interesting, as long as we're on this, just keep you in the interest, another triumph of accounting. So one of the projects Unilever is doing is it has invested in low carbon palm oil, the kinds of trees and plantations that are growing the palm oil that they're going to use downstream. Now, so let's stipulate that they have a plantation whose CO2 emissions per kiloliter of palm oil is lower than the average. Now, the issue is you're not going to put those in a package and fly them to Rotterdam and process them. And so you get all the credit for it. For efficient distribution, you just want to put this in a big barge where it's mixed up with lots of other palm oil. Okay. Now, the problem is the current standard says, well, if you don't get the low carbon molecules of palm oil, you can't get credit for it. But for accountants, we say, no, you don't have to do this. We all teach LIFO and FIFO. And why we do accounting for inventory doesn't track the physical flows. You'd never run an inventory system on LIFO. So we said, but accounting, what it does is if Unilever puts 5% of the palm oil in a barge, it's low carbon validated palm oil, even though it gets mixed up, it should be able to claim 100% of the credit for that low carbon palm oil, even though they only get 5% of the molecules from that barge. So we can have accounting really avoids foolish things like having to have a whole separate distribution channel for your actual carbon. Getting back to Mark's question, if you can get low carbon electricity on the grid, you should get 100% of the credit for those electrons, even if you don't get those actual electrons. Otherwise, nobody would be doing this. And so these are accounting solutions that avoid really problems that people are currently wrestling with, because they think you can only get credit for the actual electrons you've used or the palm oil that hit your receiving dock. So just another example of how powerful good accounting, even simple but good accounting, can be.
Yeah. Kerry, look, yeah.
Yeah, thank you. Thank you. Hi, Bob, and thanks for the great presentation. Very insightful. And I thought this e-asset ledger accounting sounds like a great idea in principle. I'm not sure how silly this question is, but isn't it so actually that to make this globally and effectively material, a really big number of companies from all parts of the world, from all stages of all kinds of supply chains, should start doing this? So this should become as normal as financial accounting plus the auditing system over and above that. So I understand this is the start, but how to make this happen?
Yeah, okay, you're absolutely...
How to facilitate the diffusion?
Yeah, so you're absolutely correct that, and the reason why, again, the climate community has not leapt to do this is you can implement this at, for everybody in the next 3 or 6 months. Carrie, just as you said, it requires everybody to be on the system for this to work. And we feel better. I asked Karthik, who's an expert on regulation, I said, well, the SEC Acts were passed in 1933. When did the SEC standards come into existence? And the answer was 1939. So it took 6 years for people, and accounting had been around for several hundred years, to still sort out the standards that could be generally applied by all companies in the US market system. So yeah, we're depending on voluntary disclosure, but Carrie, you are coming from somewhere in Northern Europe, as I'm guessing.
Finland.
Yes, okay. So one of the things the EU is considering is a carbon border adjustment mechanism, CBAM, which will be a tax on the carbon content of products coming into the EU. So the companies are not motivated to outsource production to Asia and Africa. So a CBAM mechanism is really going to be the trigger for this. And we've been talking to the CBAM people. The suggestion is, see, right now, if you don't get the actual data, like we described, from your suppliers in an audited form on the blockchain, they said, well, you can use average data instead. And I said, no, that's the wrong solution. If when CBAM goes into existence in whenever it is in 3 years, and you don't have actual audited data, you don't get to choose the median of the distribution. You get to hit with the 95th percentile of the distribution, okay? So we're familiar with the Lemons problem and adverse selection. The fact that your suppliers are not reporting to you is revealing to us there's something they're trying to hide. So we're not going to assume that it's the median. We're going to assume it's the 95th and 99th percentile. That will really motivate suppliers, even in unregulated jurisdictions around the world, to say, oh, no. Here's the data and it's audited and you can rely on it. So I think that's the kind of regulation and taxation system that will do this. And I can say that the US Congress knows that Europe is moving to the CBAM mechanism. They are already working for the next administration that if Europe does it, the US is going to do it. And that's really going to stop. And so if you're going to tax something, you better have real data. You can't pull something out of somebody's master's thesis about what the carbon content for this particular product is. People are going to want to see the real data. I think that'll stimulate more rapid, widespread adoption of the e-liability method. That's our hope.
Thank you. Okay, thanks, Bob.
And Doug, Stephen?
So I guess you don't want to go here probably, but my question is, how did we get here? How did we go from a theory of the firm that relied on narrow self-interest and very short-term value creation to now we're looking out thousands of years and we're trying to get people to think about generations that we don't even know where they're going to live, what they're going to be thinking. So I know, Bob, you've written history books like Atkinson and Kaplan about relevance lost. How did we get here? And when are we going to finally develop a theory of the firm that's going to be able to explain or predict this behavior?
Yeah, I actually think at least my theory of the firm is already there. I mean, when Milton Friedman wrote Capitalism and Freedom back in 1961 or 62, you know, the challenge the world faces was one of production. We had to rebuild the infrastructure that was destroyed in the Second World War, and we had to deliver the capabilities and benefits to a much broader global population. And Rachel Carson had not yet written Silent Spring, and Ralph Nader hadn't written Unsafe at Any Speed. And so we didn't have negative externalities in Friedman's value maximizing or shareholder value model. You know, fast forward 60 years, these are clearly negative corporate externalities. I'd like to think Milton, if were he alive today, would say, well, companies should not impose external costs on society. And we should look for a predecessor of Milton Friedman at the University of Chicago, who is PIGO, and have a Pigovian tax on the negative externalities that companies are producing. And, you know, so if we put on a Pigovian carbon tax, you know, that's a model of the firm that'll still work, at least on the pollution side of this. But, you know, there are political forces at work here, and the people who are advocating for free markets and free enterprise got much of the story correct, but there's some important parts of the story they're ignorant of, which is you want at least companies to be neutral in terms of not just, certainly pollution and the climate warming, but also harm to workers. I mean, e-liability is a way of doing supply chain accounting, and you can do it. I did it for greenhouse gases, but you could do it for worker safety. You could do it for slave labor or use of child labor or corruption. You know, if you could capture the data at its source and put it on that blockchain, then downstream companies will be able to understand when their suppliers are doing bad things that they don't want to have happen. So I tend to think of it as this more all-encompassing value approach to companies, but you reduce or minimize or eliminate your negative externalities to society. And this measurement and accounting system gives you the information to do that.
Hanan?
Yes, at the beginning, I want to thank Professor Kaplan about this very informative webinar. And the second thing to ask about if we have any obligatory regulations on world obligatory regulations until now to save our world or not, or we can use the corporate social responsibility pushing to this issue or not.
Yeah,
that's my question. It's clear?
So the issue with on the regulation is, you know, how you're regulating, and the problem, you know, it gets back to what I said about the SEC. I mean, I think companies, and getting to Doug's point, should be accountable for the environmental harm they're creating through continued emissions, and we can do it. That's the purpose of, you know, our e-ledger system. Both to reduce your liabilities and encourage those organizations that are good at removing existing carbon from the atmosphere. And so, you know, if we could just get to this as accounting and disclosure, you know, sunlight is its own disinfectant. I mean, allowing people to see what you're doing will discipline many companies. But and I wish we could put in regulation. I mean, California is trying to regulate, scope 3 and the reporting of scope 3. But the problem is it's not feasible. I mean, the scope 3 just doesn't work in a regulatory environment because of all the approximations and averages and the lack of auditability. I mean, no auditor will give you a clean SX level audit like you have for financial statements to a scope 3 report that's filled with estimates and is idiosyncratic and doesn't encompass all of your inputs. And so it's only when you get to, an accounting system like the e-ledger system that you have the basis for getting audits. And if you have audits, now you can regulate and you can tax. And unfortunately, we spent 20 years trying to understand scope 3 and we kind of lost all that time. Now, we didn't have blockchain 20 years ago, so maybe we couldn't have done it, but it's there now. And so the goal is let's adopt this system and let's get companies on. And we don't have to get every company. If we can just get, the Fortune 500 and get the FTSE 50 and the DAX index, get the largest companies in each of the major countries doing this, they have suppliers that it'll ripple out and cause that whole supply chain to start having to measure actual emissions per unit of product that they produce. That would be the voluntary approach.
It's a voluntary. There is no
For now.
obligatory issues for this for now, until now. But corporate social responsibility can push on the behavior of the companies or organization to do this as obligatory thing.
Yeah, CSR is a voluntary approach. Right?
Yes, thank you. Thank you.
Yeah, that's included within that. That's one of the levers that companies, are pushing them in this direction.
Yeah. So
Okay, thank you. Thank you, Dr. Mohamed. Thank you.
so Harris?
Yes.
So
Thank you so much. This was so insightful. Coming from a background in industry, I can see the many benefits of this method that you propose. My question was, how would you treat, say, circular economy business models that, for example, reuse material that would otherwise go to waste?
yeah, so the recycling is great because when you use them, they come with a zero carbon footprint. Basically, all the emissions that were sent up to produce that original product are being allocated to that product. And so our position is for Tata Steel or Nucor that's using recycled steel, you can assume that that input steel has zero emissions in it and then work from that. And the recycled glass in that cement substitute case that I was writing. Now, what you're describing is there could be other benefits from using recycled material by not having to put it in landfills. But, that's a different metric. And so, we'll have one column, we have a financial accounting column. We're going to have a greenhouse gas column. We could have a land use damage column. Where if you send it in a landfill, you have a liability for that landfill, and you could offset that by, instead of sending it to a landfill, send it to somebody to use in some other product. But it's just that would be a parallel accounting system for land, and you could do one for clean water the same way. So, if you pollute water in your production process, you may not be producing greenhouse gases, but you're producing dirty water. And we could run an e-liability, measure in currency of kiloliters of water. So, what we're doing here is just generalizing our financial accounting model. And instead of measuring our supply chain costs in dollars, we're measuring it also now in kilograms of CO2. We could do it in kiloliters of dirty water. We could use it in hours of worker accidents. And so it gives us the opportunity of adding additional levels of accountability to all of our own work and our supply chains. And including responsibility for disposal of products after, any waste that we are disposing of. So
That's really interesting. Thank you.
Mark?
Yes, thank you so much. Super inspiring. I'm just going to ask you whether it's a fair comment to say it all rests on what happens at the end of the supply chain with us as consumers, because now we would be able to know exactly how much CO2 was needed for anything that we buy, and we might have alternatives there. And when we just measure euros, it's clear we can only afford something, and we might go for a cheaper product, or anyway, there's a trade-off there. So at the end of the day, this all hinges on consumers then going for the low CO2 products or avoiding certain CO2 intense products. So that if that doesn't happen, none of this has an effect, right? Is that a fair comment?
Well, no, I mean, you're absolutely right. I mean, it's a little bit overstated. I mean, but I mean, the good news, Mark, you have it exactly right, that full application of this for every product you purchase, as in food, you get a nutrition label, you know how many grams of fat and how many kilocalories, but you also know how many micrograms of CO2 are emitted to make that consumer product, you know, whether it's a candy bar or an automobile. And then environmentally sensitive consumers can make preferred choices along that dimension. And that's good. Now, however, you know, you still, there is a role for government here. First, you may want to tax it upstream and not wait till it gets to the consumer to tax it. And through things like CBAM, you can say our consumers are not environmentally sensitive enough. They're not internalizing all the harm they're doing by purchasing high carbon products. And so we're going to put a tax in instead of that. And so the CBAM will help a lot to accelerate the adoption of the system and help organizations decarbonize their supply chain through their product design decisions and their sourcing decisions. But ultimately, if the consumers are not willing to live with a CBAM tax or some, you know, a value-added carbon tax at each stage, you know, and the political will isn't there, then we're not going to be able to get to those regulatory or tax solutions. And so in that sense, what you said is true. So if consumers say, no, I just want the cheapest product and I don't give a care about how much greenhouse gas is produced and I don't want you regulating or taxing me, we're not going to make progress.
Thanks.
Other than some voluntary stuff that Hanan talked about. And we'll get rewarded in some different life.
Luca Phillips.
Good afternoon, Professor Kaplan. Thank you very much for your lecture. This is a very important topic and it's very interesting. I had a question. How do you envision the accountability of firms in the future for the accuracy of these CO2 estimates going up the supply chain? So for example, company A gets carbon data from company B, you know, supplied by company B, which is supplied by company C, and so on. So how do you see the accountability of companies in ensuring the accuracy of the data that's supplied to them by their suppliers, which is supplied by their suppliers and so on?
Yeah, so that gets back to why we need something like a blockchain solution. And so what we want to do, get e-liability, you're going to measure the emissions, when they occur and where they occur, and get an assurance at that point and post that on a blockchain. And then the downstream companies will have the ability to look back up the supply chain to see where did each of these numbers come from and what degree of assurance was associated with it. And so, you know, otherwise it wouldn't work for just the reason you said. So we need both the measurement to be done where it's going to be done the most accurately, and that's where the assurance will be the easiest to do. And we'll have the environmental auditors come in and say, yes, the methods they're using for calculating the Scope 1 emissions at this site is valid, and the method they're using for assigning their Scope 1 emissions and those in their purchased products and services to their output products is reasonable. And they have reasonable controls as to how they're doing it. And we have confidence that the numbers fairly present the carbon content in the products that they're transmitting downstream. So that's where the we need that level and type of assurance.
Right. Okay. Well, the future I see in this environment would be one where there are many different companies providing assurance and doing audits in various countries with various levels of reliability all down the supply chain. And so it seems to me that there is still some element of trust. Like I know these figures are going to be presented on a block stream or on a blockchain,
Yeah.
excuse me. But at some level, company A is going to just accept the figures that went into company B's estimates, which were provided or which were calculated using data provided by company C and so on.
Yeah. So I'm not sure what the solution is here. I mean, it's a very interesting, it's an important issue. And that's why we have to spend 3 or 4 years, and companies like PwC and Deloitte have to work through this and decide how confident they are in a downstream assurance, based on the upstream data and upstream assurance. But so we need to start working on that now. This is a new world for the assurance firms because up till now they only had to work with the tier 1 suppliers or your tier 1 customers. You get confirmation on receivables and you get confirmation on purchases. And now we're going to have to go that further upstream to look at the upstream suppliers. So that's work ahead of us.
Okay, thank you very much.
Are there another question? Thank you very much, dear Professor Bob Kaplan, for your contribution and your effort. Thank you very much, everyone joining us today. Thank you very much for taking the time out to present it to us. It's been really appreciated, dear Professor Bob Kaplan.
Well, thank you. Great set of questions. Really appreciated it. Thanks for listening.
Thank you very much.